That's very. Everyone ready? All right, I'll call the Audit and Finance Committee meeting to order. Probably everyone looked over the new packet. So I need a motion to accept the minutes from
So
10.
moved.
Second. All right. Next, I guess we're gonna go over the Audit and Finance Charter.
This is the charter that was approved previously that we're asking the committee to recommend to the full board to reapprove. It's an annual requirement of the Authority Budget Office. At the same time, the Governance and Nomination Committee is reviewing all of the charters. And we would anticipate that sometime between now and the annual meeting, we'll be back to each committee asking them to make modifications to the charter that will be approved today.
This is for the existing one.
This is just to keep the one we have in place for the
And
next,
when was this done last?
last year. And these charters basically follow the format of the suggested charter that the state authority has posted on its website.
And I think we were just trying to make them more similar to
Right.
one another.
Yeah, we're trying to, and I think the state created them one at a time and posted them. So, the sections aren't all the same. And we thought that, and Andy has helped with the governance and nominating committee, but we have some more work to do there. But we could approve this one so that we're compliant.
Let's make a motion to approve.
So moved.
Okay.
Second?
All in favor?
All right.
Great. Next, we have the discharge duties in 2024. You want to talk to us, Mike?
These are the duties that this committee, a summary of the duty of the activities that the committee performed last year. Lisa needs to have the committee review and approve it so that it can be filed with the Authority Budget Office annual report on March 31st. So if there's something that you think we worked on that's not there, or something that you have questions that we're saying we did do, that entertain those now, and then you could ask for a motion.
Do you have any questions?
When will we see a 2023 contracts, like with Columbia County or these things?
Well, we have that coming up later in the meeting.
Boy,
It's been approved. It's been approved by the, it was included in the county budget. It is, we presented it to the renewal contract. It's a $460,000 annual contract for baseline economic development services. It's renewed annually. The funding was included in the county budget. We presented it as we do every January to the Board of Supervisors Economic Development Committee, which met on Monday. We'll submit it to this committee for recommendation to the full CEDC board. So they approve it on Monday, and then when it's approved by the full Board of Supervisors on February 8th or 9th, we can sign it.
great.
But it's and it's the same that we've been receiving for the last 8 years or longer. But we have these ancillary contracts for supplemental consulting contract work that for housing and
Yeah,
for
the
broadband.
housing additions.
But our base contract is good to go.
Joe or Dave, do you guys have any
I'm good.
questions? Okay. Do you want to make a motion to accept the discharge duties? Second. All in favor?
All right.
All right. Let's move to the treasurer's report.
Thank you. For transparency purposes, we do give you the detailed treasurer's report as of December 31st. UHY, you'll recall, what we approved is the auditor, and the committee and the board approved the engagement letter. They started their audit work on Monday. We did have a meeting with the partner in charge of the audit a week ago. And yesterday we went through some of the issues. Basically, if you look 10 lines from the bottom where it says total bank accounts, you'll see that we have $131,000 more in the bank than we did last year. 42,000 and 38,000 of that, 80 of that is holding funds for the county grant program, county grant program, and also the county future forward program. Columbia Forward.
The chamber thing.
Right, the one we're doing with the chamber. And what we did there was the contract is as of January 1, 2022 through December 31st, 2024, with 1 year renewal. They review it at the end of each year. The program didn't get started till July, and the Board of Supervisors didn't approve it till May, but the original contract was as of January 1. So the county paid us in full last year for that program. And so they paid us $200,000. I felt that since we hadn't performed any of the work for the first half of the year, that we would defer that income so that we could do the program for 6 months into 2025. And you just shift the whole program forward. And I think, there is an issue that they have to pay us. They have to expend all of the ARPA money, the American Recovery Act funds that they're using to pay us by the end of 2024, but we'll have the money and we'll just provide the
So
service.
that 80,000 or whatever will count.
Keep rolling forward.
And you just explain it at the yearly review.
Yeah.
That we're-
So, and Jessica made a presentation to the Board of Supervisors that she'll present to the full board on Tuesday, updating where we are at the end of 6 months with the chamber. They seem very satisfied. Now, the other is that good chunk of the money, more than half of the money that we have for general operations or of the total here is loan program. It's either money we have available to lend or money that we're holding in reserve for the SBA. So, I think that what you'll see from this balance sheet is we're pretty stable. And if we did not have 2 or 3 items, which I'll mention in a moment, we're clearly on budget, and we're clearly consistent with where we've been over the last 4 or 5 years. If you continue to page 2, one of the things that we look at here, if you go down to the second line across where it shows $1,048,000, that's the amount of loan funds available to lend. So we're $58,000 less outstanding loan balance than on the CEDC loan fund, but we're $120,000. If you look down at the loans receivable, we have $811,000 of outstanding loans on the SBA loan fund versus $691 last year. So we did 600. What was the? I don't have the number on the top of my head. $800,000 of loans last year.
Correct. Yeah.
So, I think when you look at that, that too is a strong aspect of our balance sheet, because of the total current assets, almost $2 million, almost $3 million is either loans, funds available to lend, or money on the street. So it's not noise. It makes us look, $4 million operation, but it's primarily the funds we have available to lend to clients and the money that we've already lent to them. Our fixed assets, hasn't changed much. I think we bought a couple of computers that they will put in there. If you go down almost 2/3 of the way down where it says grants receivable. 4 lines above total assets. It says Flanders, $200,000. That was a grant that was received by CEDC as a loan, which we then loaned to the Flanders Corporation out on Fourth Avenue. And after 5 years, if they meet certain criteria, it's forgiven. So then we would also would be forgiven. The loan was from the state to us, to Flanders. The county may have been in the middle there, but the state will forgive that loan and it converts to a grant at the end of the 5 years. We're reviewing the documents to be sure that they've complied with all of the prerequisites to have it become a grant. But the way this was booked initially, there's no corresponding entry like we're making now with the grants that we're getting from the state. So if this is converted into a grant, there's going to be $200,000 of forgiveness of indebtedness. And we're going to show a $200,000 loss. I think it's explainable, and also because of a couple of things I'm going to mention now. I think we're going to avoid having a net loss on our books this year because of the land sale that we're doing with the county. But let me we'll come back to that 200,000. But even if we were on budget, and we made $20,000, we're going to have a $180,000 loss.
So we received $200,000 from the state several years ago.
Yeah.
Went on the
What
books.
entity from the state?
Office of Community Renewal.
And so and then we in turn
Basically federal block grant money.
gave it to Flanders. And
Yeah.
now it's going to come up as a loss.
And
And I wanted them, when I came, what we're doing is with these grants, we just got a $45,000 grant for the creamery. So it was put on as a loan, but we put a corresponding balance sheet entry on the liability side so that when these things collapse, you're not having the public say, oh, they lost $200,000 this year.
Right.
And, Jessica has come up with a plan and a program that we get a significant fee for managing these grants. So to generate income. And right now we have almost $1 million in either on the books or in the pipeline.
There was no fee with Flanders.
If it was taken at the initial time, the first year.
Right, CEDC really should play the tax rate, right? For the money. So for the future, you feel like you book it.
We have the accountants booking it in a way that we're not going to have this take loss every time you turn around. Every time there's a gratuitous state grant, loan becomes a grant, you don't make it look like you lost money.
Yeah.
Because it's not your money to begin. So, when you get down to just below that line, total assets, we're up $447,000 in assets. We went over the $4 million mark. Now, if you look at it, close to $3 million of that is loan funds. And we did get, was it 400,000 from the SBA this year, Michael? Last year, 2022. And we're going to be applying for additional SBA funds because not only are we getting money on the street, and it takes a while to get that money into the account, but the SBA received significant increased budget allocation in the omnibus budget bill in the fall for this program. And so we're hopeful that we will get more and that it won't all be stripped away in negotiations with raising the debt ceiling next week. But could be. On the liability side, we have the normal accounts payable. We have $16,000 due to the chamber, which was a timing issue. Their fourth quarter payment on the Columbia Forward program. We have to check, but after the end of the year, we had some accrued expenses. If you go to the top of the next page, you'll see the deferred revenue. Under the deferred revenue, we're still carrying $5,200 from a grant program with Berkshire Taconic Community Foundation, but that money is in a bank account. So, and that was to assist school districts to get what they called hotspots, that they would give to families that couldn't get wireless in where they lived or couldn't afford it. We have the $45,000 from the Creamery grant, $150 from the Clock Estates, and this is showing $38,000 from the Columbia Forward grant. They gave us $50,000 so that we could give every borrower, eligible borrower, who was borrowing up to $25,000 on top of their loan, a 10% grant. So if you borrowed $25,000, you got $27.50 at the closing, but you only had to pay back $25,000. We did $14,000 of those grants last year, so we're deferring the $50,000 for this year and next year. What you don't see here is the $42,500. I'm sorry, you see up above deferred Columbia Forward money, $40,500. We're finding, we have to find the other $2,000 that goes in there. It's in another account, and the accountants, auditors are working on that. We turned over the Pat Leiden uploaded the data for them, so we're not making any more changes internally. They'll send us year-end adjustments. We do have the EIDL loan, and those, most of you are new to the board, but in 2020, when the county came to us and said they had to cut us 20% of our budget because of COVID, at that time, PPP 1 and PPP 2 we didn't know they were coming. 20% of the county funding was $90,000. We knew about PPP 1, but we didn't know how long the pandemic was going to last. So the board, in June of 2020, borrowed $100,000 under the EIDL loan program. We got a $10,000 grant up front for participating in the program. We used $6,000 of that in 2021, and $4,000 was paid in 2022. But now we have this $100,000 loan, and the government deferred payment for 2 years, but they did not defer the interest. Because we're a not-for-profit, the interest is at 2.75%. The theory was that if the county cut us in the second year of operation, we would use the $100,000 so we could make up the $90,000 they were going to cut us and not have to, in the middle of a pandemic, cut staff or reduce the services we were providing to the businesses in the county that were going through the pandemic. The original thought was that we would pay it back over a 5-year period. And I'd like to ask the committee to recommend to the board that I be authorized to begin paying that loan back on a 5-year amortization schedule, but with equal principal payments so that we're not accruing interest all up front and principal on the backside. It's about $1,700 a month. And at the end of the day, the accrual of interest for the last 2.5 years that the government deferred us having to pay was $6,500. So, but remember, we got $10,000 from them up front, so in a grant. So we paid that. I made a $7,500 payment because the first payment was due this month in January. So we are now at $99,000 on the note, and I think I probably have authority to start paying down loans, but it is over $5,000 a year.
So we need a second motion for that.
Yeah,
Oh,
motion.
no, it's better.
All these billions of dollars they can't account for, they're gonna screw us. They won't forgive us on our little.
So a recommendation to the full board to authorize
Okay.
the repayment of that loan over 5 years.
So moved.
I'm, second.
Okay, all in favor?
Aye.
Our other big long-term liability is $1,026,000 to the SBA. And that's, again, at the halfway point on that paper. And just below the EIDL 100,000. Each time you can see the last tranche of money they gave us was the full 400,000, and we have not required us to begin to
Start this
we
month.
start in January.
Yeah.
So that keeps getting reduced over time as the loan fund, as the borrowers pay down, we pay the principal back to the SBA. Interestingly enough, we keep the interest, and for the last 2.5 years, the SBA has not charged any interest on to the micro lender intermediary, which is CEDC, for the money that they've lent us. Generally, the notes that we get from the SBA give you 1 year of interest free, and then it's a nominal interest rate for the remaining 5 or 6 years on the that we borrowed from them. Next year, we believe we have this $400,000 note, I believe has a interest rate for year 2, but I think it's like 1.5%. So we will be starting to pay interest again to the SBA, but what happens is we keep the interest that we don't pay back to them, and if we're charging 3.5 to 5% in interest, and we're only paying back on the 175, and the year later the outstanding principal is reduced by 20% anyway, we get to keep that. But what we've been doing is leaving that in the loan fund rather than taking anything out for operations. And really, that's how Martha has been able to grow the loan fund, not only by getting SBA additional tranches of funding to lend, but there's over, I think it's over $500,000 of interest that we've collected over the last 8 years that has stayed in the account. And we'll have at the board meeting a virtual infogram type report that Jessica's done with Martha to show that. So, and then, so our long-term liabilities are $1,137,000, and that brings us down to our net assets restricted. The SBA microloan net asset restricted, those are the funds that the accountants will true that up at the end of each year. But right now we have $229,000 in bank accounts, representing the 15% cash collateral that we have to put in place for each of the SBA loans. So if we draw down $400,000, we have to put $60,000 in a loan loss reserve account. What we've been doing is, again, we do not take the funds when these accounts are fully paid and they no longer need the loan loss reserve for that particular tranche. We use that to roll forward so we don't have to take funds out of our general operating account and create an expense to fund the loan loss reserve account. The risk with the SBA loans is that if you had a hypothetical $100,000 tranche and you put $15,000 in reserve and you had a $25,000 loan default, we, at the end of 6 months or 60 days, we have to pay back the SBA the $25,000 that defaulted. Now, if you take it out of the $15,000, you're $10,000 short, and you need $7,500 in the or $10,000 in the reserve account to stay at 15% on the $75,000 that's still there. So the reason we've been keeping the money and just rolling it over is we don't create a risk to have to come up with, $35,000 makeup on these loan accounts. And in addition, we have $230,000 in reserve, and we have over 200, we have 278,000, I think it's $245,000 in bad debt allocation for bad debt. Now, that's not cash, but if a loan goes bad, we've already created the reserve for that, so we don't take a hit on our income statement.
You recommend we change that, or?
No, well, what we've done in the past is if we wait to see what the accountants come back with as the bottom line.
Okay.
And if there's, if you have $100,000, we've been putting 50 in the, you want to show the public that we're making a profit, but we also want to show the board that we're adequately protecting ourselves. And with $2 million of outstanding loans, you'd have to have 15% of the loans go bad before we had brought that down to a level. And the accountants don't like you to put too much into that allocation of loan law of bad loans, because again, it is and it's more in a bank because you're a profit. You can put income to the side and hold it for other purposes, and they don't like that. But they will do an analysis with us. Martha and I go through every quarter the whole portfolio, and we have to put a risk score on that, and that then calculates what that number should be. And we've always been under it since we've been putting more in it. There are two things under net restricted. One is called county directed, and the other is called net assets commerce park principal. And they total about $120,000. What's not on here yet, because it hasn't been booked, because we were waiting for the accountants to tell us how they wanted us to do it, is $88,000 that the county directed the IDA to transfer to CEDC for us to purchase the lot on Route 9H. The 120 was derived from previous land sales that CEDC did on behalf of the county, where instead of sending the money directly back to the county, like we've done with some of the other sales in the Commerce Park, they asked us to hold it so that we had those funds available for county-directed projects. And the $77,000 on our books right now is being held for the water tower improvements at the Commerce Park, but the county has directed us to use those funds in a resolution to buy the property. So we did buy the property, but if you take the 120 and the 88, and there's an additional $10,000 that we received this year as the final payment on a sale that occurred previously where we took back a note. That gives us $210,000. The closing for the $224,000 parcel of property, when you include the appraisal, the environmental analysis that we did as part of our due diligence, and legal and other closing costs, was approximately $230,000. So we're going to book a $20,000 due from county on our books, and they understand that if they decide they want to have us transfer that parcel to them so they can build a Meals on Wheels and home health care headquarter facility, that they would pay us $20,000. If they don't buy it, then we put it on the market and sell it, and we keep what we get. So that does, though, is the accountants are now telling me that we have to report the $88,400 that the IDA is passing through to us from selling the county property as a grant. And we also applied for $40,000 under the federal earned employee retention credit. They're telling me they have to book that. So if you take 40 and 88, you have 128, and we have a $77,000 net income on the P&L, which brings us up to $205,000. if we write off the Flanders 200, we're going to show that we made $5,000 this year. It's a little complicated. The auditors are working on this so that it's much clearer than it comes. My question to them is, well, if that's the case, in 2 years, if the county says, give us the property, we gave you the money to buy for us, are we going to have a $200,000 loss or a $230,000 loss on the property? And if so, you know, how do they want to book that? I'd rather take the loss on Flanders and explain that it was a grant that created jobs and kept a 200-person business in play, as opposed to we bought a piece of property and gave it to the county. But so in that case, we would show the $200,000 loss this year, because my argument would be the county had us hold money for a directed purpose. They directed us to buy a piece of land, which we're holding for the county to give back to them.
Right.
So my argument would be that that transaction, you know, shouldn't create income and expense in any 1 year, because it's simply we're holding a piece of land for them instead of holding cash for them. But you know,
So
Ryan's probably cringing as a CPA, even listening to me describing this strategy.
A little bit. I'm not gonna lie.
But we'll do whatever they tell us. So you know, jumping to the P&L. You know, we're ahead of budget on administrative revenue because of the Office of Community Renewal grants that Jessica's working on. We're ahead by $94,000 because we booked half of the county money as well as the money they given us for broadband. We're you know, $10,000 below budget on membership. And our total income, we are up on the microloan program because they only tell us in April how much we're going to get for the July 1 to June 30th fiscal year. So I always are conservative based on what we received the previous year and a half. And they brought us up from 180,000 to 230. Based on the fact of our loan volume. So here we have based on this, without any of the land transactions, we're at 954, $120,000 over budget. When we go through our expenses, you know, we're under budget on conferences, we're under budget, we're $2,000 over budget on consulting. We did put the broadband expense there, took it out of new initiatives because it's no longer a new initiative. It was a contract with the county. We flip to the next page and go halfway down to total payroll. We were $41,000 under budget, but that's because it took us half a year to fill the position that Jessica's in, and almost a full year to fill the position that Stephen is in. And so our rent is on budget. We do a 5-year lease with a 5-year renewal. The renewal is next year, so we will get the notice that we want to stay. Our insurance was under budget, although we did review the insurance and we've added additional employment liability coverage and cybersecurity coverage, together with the directors and officers insurance that we carry for all of you. We were slightly over budget on the micro business program, but again, you know, we like to spend at least 20% of the grant money we receive hiring technical assistant consultants to assist businesses. The rest of that money is used for overhead and salaries. You know, we've talked about the fact that we were $56,000 over on office expense. There's nothing new there. That number has not gone up. It was primarily the fact that we had not budgeted for the memberships under dues and subscriptions that we have had to, that we traditionally joined. And we had under budgeted $10,000 on computer equipment. And we had not budgeted for the $4,000 for the loan software. But again, as we get to the bottom line, we're still ahead. We flip to the final page. Our professional fees were over budget, but it was only in the accounting and audit fee category, and that's because it wasn't until year end that the auditors determined that we had received sufficient federal money that required them to do a single audit of the whole organization. And it added significant accounting expense. And they charged us $3,200 to apply for the $40,000 employee retention credit. And we had some outside bookkeeping consulting, because you'll recall the accountants told us they could no longer, because of having to do the federal single audit, they can no longer give us day-to-day accounting advice as to how to book things. So we had been using CFO for Hire in Albany, which is now owned by BST accounting firm. We're now using practice in Rhinebeck Results, CULCH. Their CPA firm in Rhinebeck, and the rate was 130 in Albany, and the rate is 75 in Rhinebeck. So, the rest of the expense, you'll see I budgeted for minimal SBA interest expense, but because of COVID and because of the most recent loan that does have a 1.5% annual interest rate has been deferred, there was no expense there. So we're $77,000 to the good. We'll see what the auditors say about the Route 9H land transaction, and also our treatment of the half of the county money as deferred. They're reviewing the contracts for both of those transactions to determine what we're allowed to do. But that's how we submitted it to the auditors. The thing that jumped out at me was when you go back and look at our total equity on the next to bottom line of the balance sheet, and it's 77,161, and our net income is 77. It's the same number. So I do want to see, I want them to check that. But so it's a complicated, we have 118 loans. I think was that today we looked at.
I think it's 112.
Well, we just did a report to prepare the new dashboard for the board. And it may be because we paid some off, but as of December 31st. Okay. And so there are 12 monthly payments for 118 transactions. So, Cat is processing all of those. We have vendors, we have member checks, we have grant money that's coming in. So, there's 1,500 loan checks. We did buy the module for the software, our loan software, to be able to do ACH payments for borrowers that give us permission to go in their account and take it out directly. We would encourage a small business that isn't sure of their cash flow not to do that. But again, we also looked at it, and there are 5 borrowers out of 118 that are delinquent for a total of $2,300, which is 0.25%, not 1%, but 0.25% of the total outstanding balance. So when you look at, Martha's efforts with collections and nurturing the client, not to a point where they want to pay us first, even if they're, and because our loans are smaller and our payments are, generally under $1,000 a month, even at the highest level. It's an incredible, when you're loaning to when your program is designed to loan to startup businesses that may or may not have history or credit, it's a pretty clean portfolio. But we have been talking about the fact that, now that we're over 100 loans, it's even hard to remember, it's not the 50 clients that you knew, and we are looking at how we can come up with some, touch the client to keep that personal engagement. But I don't know if you've all met Steve Vandenberg, but I think some of were you at you started the day of the board meeting?
Yeah.
So I think most of you have, but he and Martha have been working on this, and we're also looking at some diversification in the portfolio. Martha and I talked about the fact that the college has a new program to train daycare workers, and it's in partnership with the family of Woodstock. And I think there are 4 people in the certificate program in the first wave, but they have 3 or 4 signed up for the next. That we're looking to explore and bring it to the loan committee and board for approval, but perhaps a dedicated $150,000 of the $1.4 million that we have available to lend to perhaps loan to businesses that would qualify, or give them technical assistance to set up their daycare business in a way that we would have some marketing. First, we'd be helping small businesses in an area where there's a great need. And second, by announcing CEDC has created a $150,000 loan fund to support daycare centers. So I think it's us out there to, again, the mayor's point previously that most people don't know what we do. We do have a chart that shows over the last 8 years, we've done $4 million in loans, and we provided over 500 businesses with technical services, and there are only 2,000 businesses in the county. And I think we are looking at how we can market that. When we presented that to the Board of Supervisors Economic Development Committee, it made them realize we weren't, as I said, we aren't just cheerleaders and people that you hire to do work with grant money, and that we're actually serving, our main business activity is providing direct service and support to small businesses. The loan report is included here. I think where is it? Yeah, it's in the back. We are going to have discussions with council as well as with the loan committee that we're going to go to a dashboard. We think that we want to be more protective of the individual credit information relating to any one client in a way that better complies with privacy laws and best practices. So we'll be reporting, we have 118 loans. There's $1.8 million outstanding. Out of that, there's 3 loans in the SBA portfolio that are delinquent, either in 30-day or 60-day, and the total amount is $2,000. And then if the board member is at a committee meeting or a board meeting, we could go in executive session to discuss a particular client that we want to bring to your attention, or a particular, if you saw all of a sudden we went from 30-day $2,000 to 60-day $50,000, we might want to go in executive session to explain that. That's great. Last thing, there is a profit and loss by class. And does tell a story. If you go to its last page, it shows that net income from operations was negative 3436, but we have a $77,000 profit. So you can see, $71,000 of our net income came from the interest earned on the loan fund. Now, in the past, there have been times when that operating number has been higher. And because we left the cash in the loan fund, if the operating deficit was significant, it reduced our overall cash on hand retained earning money. So, there were years where in the aggregate, we had a net positive income, but on a cash flow basis from our operating bank accounts, those were reduced because the money was in the loan fund. And I think we were concerned that we didn't want to reduce our reserve accounts below 600,000, which we haven't. But at the same time, we didn't want to overly use cash from the loan fund to subsidize operations. We wanted to get operations where they were self-sufficient. But we have looked at what other small business loan funds are doing in terms of a percentage administrative fee, which we haven't taken, and right now we don't need. But we do want to keep focus on the fact that our total profit is going back in the loan fund to support businesses with new loans, not going in reserve. And if we do jump back to the balance sheet, and we look at the operating bank accounts, we have $418,000 in our various operating accounts at Key, and we have $213,000 in reserve at Bank of Greene County, and so we have $630,000 of cash reserve. Finally, we are looking now that the interest rates are going back up at our interest on $1.8 million in the bank, and reviewing the service fees. And we are, service fees looked high this year, but we went back and KeyBank didn't credit us. Sometimes they sign us up for services that are size we don't need. Is online banking sufficient, or do you need Key Navigator? And I think Key Navigator is $90 a month, and the other is $30. So the other thing we're looking at is our bank fees were high because when we're doing closings that require counsel, we've been wiring the proceeds of the loan to Andy's IOLA account, so that he has the funds on hand to disperse to the client at the closing. We can't get around a $30 close. I think we did 18 of them. So, it doesn't add up to a lot of money, but if you're looking to where your money's going and why your bank fees look like $3,500. And so, we might either, I don't want to go back to checks, but maybe there's an ACH and where, it goes to you and we just have to do it a day and a half or 3 days ahead so that you have the money. But, we are, I guess I wanted to give you the sense that we are looking at granular stuff too. When I first got here, we were able to negotiate with the banks to get 2 to 3% interest, and on $2 million, we were bringing in real money. Now, obviously, interest rates went down to 0.05, but now they're back up to 4%. So we want to look at where we have reserve accounts, where we know we're not going to use the money. Maybe even consider some CDs.
Question, Hudson IDA, with their big loan is repaid. Is that in here?
Yes, well, it came off the balance sheet. So when you look, if you do a comparative balance sheet, those who are new, we loaned $200,000 to the Hudson Development Corporation. We had a $10,000, it was an interest-only loan, and we did take $10,000 of the net proceeds of the loan and put it in a reserve account. And you'll see that reserve account now is zero because they paid us back mid-year. I think it was a good thing to do. We have developed a good relationship with the Hudson Development Corporation. We are all working with Misty McGee, their newly appointed executive director. And, it's, and that also brings up the issue I had raised at a board meeting about the Friends of the 7th Street Park, perhaps looking for a loan to backstop a state grant. That grant is coming through the Dormitory Authority. And while I told them we would entertain it, depending on the program that they were getting the funds from, and evaluating the likelihood that the assignability of that grant to us to repay that loan. But the state told them that they can't borrow the money from anybody to do it, so we're off the hook. But at the same time, I think they were grateful that we were willing to explore it. I'm not sure that I never represented that the board would approve it, but I think we got a lot of goodwill from it. The goodwill also came because we went to HDC, who has, when they sold the CAS property, they received $3 million. And we said to them, would you want to do this rather than us so that we don't look like we're coming in over the top? And they came back and said they didn't want to do it, but thank you for asking.
But the 200 grand from that was
Yeah,
repaid in
It's
its books.
repaid in full.
Okay.
That's why the CEDC loan balance is, there's more money available to lend than we had last year.
Okay.
So,
Brian, or do you guys have any questions? Okay, let's make a motion to accept the treasurer's report.
and Brian, when we get the draft audit, we'd like to, I'd like to come up and sit down with you and go over it. I know, we can benefit greatly from your background and professional licenses in this stuff. And hopefully it was somewhat easy to follow, but I do want to see, can we get all the grants in one place? Can we get all the loans in one place? I mean, it's still, I find the presentation of the report still awkward.
Okay, so we have a
If-
motion. for it. Do we have a
Yes.
second?
Sorry, I was just going to comment, Michael. And again, sorry, everyone. I apologize I couldn't be there today. But yes, I'd love to sit down with you and review it. And definitely the land grant accounting does give me a tiny bit of pause. But I'm sure when the auditors get through everything, I'm optimistic they'll be able to give us a pretty clean explanation as to how they handled it the way they did. I'd hate to see a loss come from a transaction like that on CEDC's income statement. To your point, I mean, the optics of it would be odd, but I'm just optimistic that they'll have a pretty clean explanation once they have gotten through everything. And I say that having not had a chance to review any of it in any detail, right? So
I'll get you up to date on that. And the reason I brought it up, it was not to suggest to them that they do it in a way that was advantageous, but so that they understood the true import of the transaction, so that it was reported properly under the standards that they are using now that we do a single. And they also said because of additional federal monies, we might have to go to even a higher level, or they might have to look at more than one audit program. I don't understand that, but I'll catch up with you on that later.
Okay, so we
Yep,
have a
happy to
motion
explain
accept
that.
the- We have a second?
Second.
Okay, all in favor?
All right.
All right, let's go to the portfolio report.
Martha?
No, I think Mike touched on this already. We have 4 clients that are in arrears, and in fact, one has made a payment since this report was printed. So we are working with the 3 that are in arrears. So let me clarify that. We're trying to connect and work with those 3. And I guess they've been behind.
We did have one, there was a loan, $60,000 from a project that 10 years ago had not gone forward. and the owner of the company, continued to make payments. And we were a little concerned because the payments stopped for 2 months, but they paid the loan off in full. So I think they just stopped paying because they were going to refinance it or use other funds to pay it off. So, that was
A relief.
a relief. And again, if you take, they were $22,000 of the $4,000 of delinquent loans here, and if you take that out, you're down to 0.25% default rate for delinquency rate, not default.
Well done.
And the county was very happy that the land is purchased. Unfortunately, the gentleman we purchased it from passed away 2 weeks after the closing. And it would have been by necessity tied up in the estate for 6 months if we hadn't closed. So I want to thank Andy for that. And also, today is our kickoff of our affordable housing task force, and want to introduce Chris Brown, who joined us a week ago, who's going to head up our housing program. First thing he suggested is that we change the title from affordable housing, because affordable housing means so many different things to so many different people. So we're going to discuss that today. What did we come up with?
Well, the original, if you look in the housing brief, or actually it's from the housing forum, Duncan Barrett's recommendation was for it to be a housing development coordinator, so some form of catch-all phrase.
So we're going to probably move to that today.
We'll bat that around. I don't know. I think it depends what the task force says. I would like for them to both be the same wording.
So we can change, yeah.
If the task force is having development task force, then we'll stick with the development coordinator.
But Chris comes to us from the Berkshire County Planning Office in Pittsfield, and previously, just the 30-second elevator speech, please.
Oh, okay. So this is the most recent step on a second career for me. So I started with the city of Troy, managing their vacant buildings there, and that spun into co-creating the Troy Community Land Bank. That kind of kickstarted my interest in affordable housing and redeveloping housing. Getting priced out of Hudson really kickstarted my interest in affordable housing. It took a few years for me to get back here, but this is where we're trying to get for 4 or 5 years now. So this position in this location is perfect. So I'm really excited to get started.
And the good thing is because we're very focused regionally with Chris's work in Troy. Many of the regional housing leadership that Jessica and I know from our work in the greater region, he knows as well. So we're very glad to have him, and I know the supervisors are excited about moving forward with this program.
Their meeting is tonight.
4 o'clock we'll give you the YouTube link. But we have 12 members of the
It's on the website, on the front page, there's a link to where you can log
On our
into the. Okay.
there are 12 task force members, and there are 10 professionals who are on our advisory group. And the advisory group was created for people whose day job it is to support housing, because the supervisors wanted to have community representation on the task force itself. But for instance, we have the head of Habitat, the head of representative of the Columbia Green Board of Realtors, representative from Catskill Hudson Housing Coalition. So
Michelle's on that. as
and
well?
Michelle and the city housing coordinator. So anyone that's day job was to support housing, we wanted you at the table, but we didn't. We wanted volunteer community representatives for the task force itself. And it'll be co-chaired by Supervisor Ron Knott and Brenda Adams.
Okay, I don't think we made a motion to accept the portfolios report, so
I move.
second, all in favor?
Aye.
Okay, do we have any public comment or questions? I don't think we have public discussion. You have something?
I was very curious.
That's all we
Good,
have.
all right,
Move that we adjourn.
all right. All right, let's vote to adjourn.
Aye.
Aye.
Thank you, and thank you, Brian.
Okay.
All right.
Thank you.
Chris and
Thanks,
I are
Mike.
We're off to Hillsdale.
Thank you.